Hello, my name is Joe Hoyle, speaking to you from the University of Richmond here in Richmond, Virginia, and the co-author of your financial accounting textbook. You've now read Chapter 3, and I want to go through my top 5 list of the information, the ideas that were presented in this chapter. I hope you've thought about it. I hope you have your top 5. Here is my number 5, and that is the idea that when a company has a cost, when a company spends money, that cost, can either be reported as an asset or as an expense. For an accountant, that's a very difficult decision sometimes to make, because it will make the company look different based upon how it is reported. The idea is that if the cost has a future benefit, if something is going to happen in the future to help the company generate revenue, then that cost should be reported as an asset. But if that cost has a past benefit, if it was used in the past to generate revenue, then it should be reported as an expense. So you can determine if something is an asset or as an expense based upon whether it has future benefit, whether it has future value, or whether it has past value. To me, that was the 5th most important thing that I saw when I went back through Chapter 3. Number 4 for me was the principle of conservatism. When you hear business people talk about accounting, they will often use the term conservative because the principle of conservatism underlies the reporting that a financial accountant does. However, this term is often misunderstood, and that's one of the reasons that we placed it so obviously in Chapter 3, so that you would see it and you would come to understand what it means. The principle of conservatism says that if there are 2 outcomes, then you should report the one that is the most likely. Your job as a financial accountant is to present fairly the financial information. However, often it is impossible to determine which of the 2 outcomes is most likely. In that situation, the accountant will always choose the one that makes the company look worse. That is the principle of conservatism. When you cannot tell, when the outcomes are equally likely, then you should choose the one that makes the company look the worst. Why? Because that's a way to help protect the outside decision maker. It keeps that outside decision maker from being overly optimistic. Number 3 on my list was the accounting equation. Assets equal liabilities plus stockholders' equity. That has been a term, that's been an equation that has existed in accounting since its earliest days. And the reason is fairly obvious. Assets have to come from someplace. They do not appear by magic. Assets can come because you incur a liability. You borrow money at a bank, for example. That's one place that you can get an asset. You can also get it from an owner. An owner can contribute assets to a business. Or you can get assets from operations. You can buy and sell inventory to increase the assets that you have. So therefore, assets can only come from liabilities or stockholders' equity. And stockholders' equity is divided into 2 sections. Contributed capital to show the amount that the owners have put in, and retained earnings to show the amount that has come from operations. Assets will always equal liabilities plus stockholders' equity. That accounting equation underlies the reporting process, and for that reason I placed it number 3. Number 2 for me was the computation of net income. The reason is that most organizations really highlight their net income. They let investors and other decision makers know how much profit, how much net income they have made. So you need to know, if you're going to be a good decision maker, what that net income reflects. On an income statement, you include revenues and expenses. As we've discussed often before, revenues is the increase or inflow of net assets from selling a good or a service. Expenses are the outflow or decrease in net assets in hopes of generating revenue. In this chapter, we also added gains and losses. Gains and losses is when you sell something or have a transaction that's not part of the day-to-day operations. If you are, for example, selling books, that's your primary operation. If you sell a piece of land and get more for it than your cost, that's a gain. If you sell a piece of land and get less than cost, that's a loss. Why is that a gain or loss and not revenue? Because as a book company, that is not part of your primary operations. And to me, the number one thing in this chapter is the composition of financial statements. The entire chapter is built around the idea that you have to have a mechanism to convey financial information. And that mechanism is financial statements. So you need to know that if you pick up the financial statements of an organization, you're going to see an income statement, a statement of retained earnings or a statement of stockholders' equity, a balance sheet, a statement of cash flows, and all of the notes that help describe those financial statements. When you get out of college and you begin to work in the business world, you will see financial statements everywhere as companies and other organizations attempt to pass out their financial information. You need to know what is made up in those financial statements. And to me, that was the primary number one thing that we did here in Chapter 3. Introduce you to each of those financial statements. Now, what were your 5? What did you think were the 5 most important things? That idea that you look at this chapter and you read the material and then you think about it is a very important aspect of your gaining an education. The purpose of this course, the purpose of this textbook is to help you learn. And making these evaluations should do that. Hope you enjoyed Chapter 3. I genuinely hope you learned a lot of material about financial accounting in this chapter.